Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of its crude by tanker to Asia. Adding the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. U.S. Trade Representative Jamieson Greer says trade talks with Canada have fallen behind, while talks with Mexico are moving ahead. Greer's comments in a U.S. television interview come as the administration prepares for this year's review of the Canada-U.S.-Mexico agreement. The existing CUSMA Pact runs to 2036, but leaves room for a range of negotiating formats, including a clause that allows any country to exit with 6 months' notice. The Teranet National Bank Composite House Price Index fell for a third consecutive month in February. The index covers Canada's 11 largest markets. The number of houses sold in February fell for a fourth consecutive month. On an annual basis, a 4.4% decline was recorded from February of 25. On the upside, some Quebec and prairie markets moved away from the trend and posted growth last year. And taking a look at the markets, it is an off day after that little mini rally for the TSX. It's off by 1.3% almost, dipping down to about 32,500, pretty much every indice in the red right now. And south of the border, similar situation, not quite off as much, but down nonetheless. The S&P 500 down by 0.7, the Dow 0.94, and the NASDAQ by 0.82. Well, the Bank of Canada held its key interest rate steady at 2.25%, maintaining it the same since October. Governor Tiff Macklem saying there are more outcomes to consider and more factors impacting Canada's economy after the Iran war began. To discuss this further, we're joined now by Paul Beaudry, former BOC Deputy Governor and professor at the Vancouver School of Economics. And Paul, thanks very much for joining us today.
My pleasure.
No surprise, I guess, that it didn't move. Were there any other options even on the table?
Well, there's always options, but yes, it was not a surprise. Everything was coming in. If anything, at this point, we kind of like the data was on the weaker side. Inflation came in nicely, even below 2%. The economy's not creating jobs. It's kind of been this reverse. It's been slow, and it really is. So that was all on the side, at least maintaining or even potentially talking about further cuts. But now with the Iran crisis and the Iran war, really the oil price will be what's going to affect decisions going further. But for this one, it really wasn't a surprise.
Now, from your experience, is this one of the more complicated situations for the BOC to deal with?
Oh, very much so. This is a very complicated situation because, like I said, the Canadian economy is not doing especially well at this point. It's not growing very fast. The projections by the Bank of Canada is for slow growth. Employment is slow. Everything's a bit slow. Inflation is well on target. So, that would be kind of the idea of potentially even trying to think whether we should have rate cuts. But now on the flip side, with the Iranian case, we have oil going up. This might kind of create inflation. Certainly in the short run, it's going to create inflation. The question is always whether that inflation's kind of get entrenched in the system. And that's really what the Bank of Canada doesn't want and might have to raise rates. So that's really a kind of pulling on both sides, really the difficult situation for the Bank of Canada.
When they get together and have their meetings, what are the conversations like? Are they heated or are they calm and collected when you're discussing especially something like this? Have you ever seen a situation similar to this?
Well, I mean, back in the COVID period, we certainly had situations that had some resemblance of this. It wasn't exactly the same because the labor markets were tighter when we were having inflation. But still, these were really tight things. Now, the discussions are generally very kind of thorough and kind of thoughtful. And, the Governor Macklem and the deputies really get together and have several days to discuss what they're thinking. So that really gives time to really cover a lot of elements and really try to bring in a very thoughtful decision.
And is it usually a consensus on it, or can there be a fair amount of dissent?
Well, I'd say, kind of coming in, there can be obviously dissent. People have different views coming in. But the whole idea is trying to discuss that through and to come a decision that everyone's comfortable with. And so there's really that aspect of trying to favor a consensus. If someone has a different view, it's a bit of back and forth in trying to discuss what's happening. Why do you have a different view? Can we kind of convince you on one view, or should you be convincing us of a different view? And so there really is time to do that. And so by the end, it's generally a very consensus type decision.
All right, now back to today. Moving forward, is the oil and the concern about Iran, is that the key thing right now?
I do think so. I do think it's a big concern. Like I said, we'll see the next inflation numbers will be up. I mean, oil goes right into gas prices. Everyone can see it right at the pump already. We're seeing some of those prices. The question is whether we see a lot of other prices being affected. So oil gets into the production of many things, and especially food that's been high on the inflation part. So the question is whether that expands. If it starts showing up in a lot of aspects, then you can kind of get this entrenched where other goods are kind of going up because these other inputs are kind of coming up. All that kind of gets moved on. If it doesn't, if we just see prices kind of show the increase in the price of oil and other things kind of just readjust and stay where they are, then it will be easier for the Bank of Canada to keep its rate. But if we really get an expansion in many things, it might need to kind of think of considering a hiking the rate. My impression, given the situation in Canada, more likely will keep rates at the same level for a while. But again, I think the Bank of Canada is very open to increasing if it really has this inflation pressures kind of expand and get wide-based.
And what kind of a factor is the CUSMA talks? We heard Jamieson Greer today saying that Canada has fallen behind and that Mexico is moving ahead. What kind of an impact does any of that have?
Well, that's kind of going on the other side. That's why everything's so difficult. With the CUSMA talks kind of behind and everything, that's putting more uncertainty in the economy. So we have this aspect that, if you're a business, what are you waiting for? You're waiting a lot. Well, a lot of businesses, all the ones that kind of are kind of touched by the export sector, importing different things, want to know who's going to be in the future. And so a lot of investment just stays in the background and doesn't kind of go ahead. So we get a wait and see type of aspect. So this is not good in terms of the growth aspect of the Canadian economy. So that's on the flip side. That's why exactly this is a very difficult part. You get the Iran kind of situation on one side, putting pressure upwards on inflation, and things like CUSMA creating this uncertainty, creating this delay, reducing kind of demand, and kind of putting downward pressures on the economy. Very difficult situation.
And concerns about stagflation?
Well, that is almost by definition what is the kind of concern about stagflation. One side of that inflation and one side of kind of being in a kind of stagnant or not very high growth economy. And that's where we're going. The idea is whether it will turn out to be that bad. We will have a period where we'll still be growing slowly and we'll have some inflation. As long as it doesn't get entrenched and kind of start kind of holding up in a kind of broad sense, the Bank of Canada might manage to kind of keep interest rates where they are and just keep that lid on inflation by telling people we're going to take care of this. And
would you like to be back in the middle of all this?
Well, it's always kind of an interesting way, but I get back at the university, we get to discuss it quite a bit, me and my students a lot.
All right, we'll leave it at that. Paul, thanks very much for joining us today. We appreciate it.
My pleasure.
Paul Beaudry is the former BOC Deputy Governor and professor at the Vancouver School of Economics. Well, as the conflict in Iran continues, we're uncovering why our next analyst says the AI sell-off is less of a macro thesis and more rumor-driven. That's after the break. Iran's intelligence minister Esmail Khatib has been killed in an overnight airstrike in Tehran, the latest high-level assassination in the regime. As the conflict escalates across the Middle East, our next guest says opportunity remains in defense. Joining us now is Matt Orton, Chief Market Strategist at Raymond James Investment Management. And Matt, thanks as always for joining us. Defense right now everybody must have their eyes on it. Matt, can you hear me?
Yes, I can, Roger.
Oh, there we go. Okay.
I've been telling our clients for quite some time that they should be playing defense with defense. Defense has been a key megatrend that we have been looking at and investing in for really the better part of the past 9 months or so, because you're seeing earnings appreciation, you're seeing increased investment from federal governments around the entire world, and this sets up a really good backdrop for earnings to continue to accelerate higher. And then this year, you throw in the conflict with Venezuela to start things off in January. Now you have the war that's happening in the Middle East. All of this benefits the defense complex. So if you're worried about geopolitics, having exposure to defense is a way you can hedge your portfolio a little bit. But I also think it's a way that you can have something and feel comfortable with its holding over the longer term. It's an area that we like a lot, and we favor both up and down the market cap spectrum.
And I was going to say, is there any one area you're focusing on?
So within defense, the area that we like the most happens to sit within the integration of artificial intelligence and technology, along with unmanned drones. So when you look at kind of this higher conflict environment we're in, what's really important is that you get people out of harm's way. So there's companies that are looking at autonomous underwater vehicles. There's companies that are investing in cheaper drones, more precise drones, and then all of the equipment and the ecosystem that goes around building that out, from the optics to being able to map things out, to being able to actually execute some of the tasks and being able to communicate with those pieces of equipment. All of that has an entire ecosystem of investments. And that's what's so exciting about the defense space, is that it's very wide. It's not just your traditional defense contractors. It spans industrials, it spans technology companies, and there's a lot of opportunity across the entire space for longer term investments.
And that kind of segues nicely into AI, and many investors shying away from it. They thought they were overextended, and you're saying no, AI has a lot of opportunities.
Yeah, that's exactly right, Roger. I think the overstatement of some of the hype that AI is going to kill everything, especially in software, I just don't buy into that full narrative. It's certainly true that there's going to be job losses as a result of AI. There's certainly going to be a number of companies' business models that are blown up as a result of AI. But it doesn't happen all at once. And especially in areas like cybersecurity, where there are such hurdles to being able to integrate and having to test and having enterprise level security and comfort that needs to exist, these things are not going to change overnight. And if anything, I think cybersecurity companies are going to be long-term winners, where they integrate artificial intelligence into their software platforms that they're delivering to bigger agents. And we've actually seen instances of some of these open source models actually copying malicious software into the cybersecurity offerings that they're trying to create, which, if anything, just highlights the need to invest in these well-established cybersecurity players in the software space. And beyond that, looking at semiconductors, which have been an area of strength, there's just a long-term tailwind to the need to build out more advanced chips, package those chips. We heard the optimism from Jensen Huang this past week at GTC. So I think there's a lot of reasons to remain optimistic on the build-out of data centers, chips, compute power, all of which is going to be necessary to realize the vision of artificial intelligence in the future.
All right, and maybe we've got so many questions to get through here. A little more caution when it comes to emerging markets. They've been taking a hit lately with everything that's unfolding in the Middle East.
It's been tough in emerging markets lately, Roger. And while I'm still optimistic about emerging markets over the longer term, there's going to be bifurcation that happens. And I think investors need to be more selective about the countries that they have exposure to. So I'm not ready to wade in and buy the dips in emerging markets. But when I am, I think areas like South Korea will make a ton of sense, in Taiwan, that have that AI semiconductor exposure that we just talked about. Mm-hmm. And then you're going to want to lean into the emerging market countries that have positive exposure to hard assets and commodities. So think Brazil, think South Africa, countries that have exposure to gold, to metals. Brazil in particular also has exposure to oil and is a little bit more independent. So they stand out as perhaps a beneficiary longer term once we get a little bit more clarity on where the geopolitical situation is going to take us.
I was going to say, you said you're not ready to buy the dip now, but you're waiting. Is that what you're looking for? You want that clarity in the Middle East, or would there be other signs too?
I think we need to have some clarity with respect to when the strait's going to open. Whether or not the war continues, whether or not missiles are still being fired, I think what matters most from an inflationary perspective and from where investors are is where the price of oil and gas goes. And that's really dependent on what happens in the strait. So watch that. And that's going to give me a signal in terms of when I want to start adding some exposure to these areas where opportunities have been created as a result of the market volatility.
All right, and the U.S. dollar, it's been on a bit of a ride with everything that is unfolding as people look for a safe haven. Canadian dollar's kind of ridden along with it. How much longer do you think the U.S. dollar can go in that direction?
Yeah, I think, Roger, the U.S. dollar is looking a little bit stretched. There's technicals that can support a further appreciation of the dollar, but longer term, I think the downtrend still remains in place. But it also comes back to the price of oil, because we've been in this environment where it's oil up, dollar up, rates up, equities down for the most part. So it's going to be oil that breaks the cycle of the dollar. So again, it all comes back to when do we have the expectations that the Strait of Hormuz will open up and that we can start getting more oil supply to the market. And I think that can help start to bring a downward trend back to the dollar.
All right, we'll wrap it up there, Matt, but thanks very much for joining us.
Thank you.
Matt Orden, Chief Market Strategist at Raymond James Investment Management. Coming up, shares of High Tide were up after the company beat expectations in its first quarter. We'll hear more from their CEO after this. Legendary Bud the Spud from Prince Edward Island will be heading to Mexican markets and eventually Mexican dinner plates. The Canadian Food Inspection Agency announcing a deal with its Mexican counterpart to export fresh Canadian potatoes. And for PEI growers, it's a much needed boost. CTV's Maria Saru has more.
In PEI, there's a frontrunner for the kind of spuds most likely to be sent south, russets.
For the most part, we would be trying to provide the Mexican people with something that they don't have on offer down there, not in direct competition with, the varieties that they grow.
Canada's potato industry relies heavily on one key buyer. The U.S. is by far the most important market, taking 93% of the country's fresh exports by dollar value in 2024 to 2025. So, with some uncertainty about the future of CUSMA and North American trade, the industry says diversification helps.
It's always good to have new markets that are tariff-free, or where you can have a bilateral agreement between the countries, are especially advantageous.
Canada already ships frozen potatoes to Mexico, but the new agreement announced last week by Canadian and Mexican food safety officials allows shipments of fresh Canadian potatoes. It's a market that's been solely supplied by the U.S. in recent years. But while U.S. potatoes are trucked across Mexico's northern border, maritime shipments will likely arrive by boat to southern ports, says Ray Keenan, CEO of Rollo Bay Holdings, who was part of the delegation that explored this export opportunity.
We won't be going anywhere near the north of Mexico with our product. We'll be going further down.
While this agreement gives the industry permission to build a trade pipeline, planning is still in the early stages. The hope, however, is to ship potatoes going into the ground this year. Maria Saru, CTV News, Charlottetown.
Well, shares of High Tide were up after the Canadian cannabis company reported a revenue beat in their first quarter, sharply narrowing their losses from last year. For more on this, I'm joined by Raj Grover, CEO of High Tide. Raj, thanks very much for joining us.
Great to be here with you, Roger.
All right, yeah, you're up. You're lit off a little bit right now, but we won't talk about that. Your revenue, though, is up 25% over the last year. What is driving that?
Well, we've always been very keen on operational outperformance. High Tide has been a leader in the cannabis retail market here through our Canna Cabana brand for a very long time. We are the highest revenue generating cannabis company in Canada. We have been over the last 3-4 years. The main reason, Roger, for this outperformance is our Cabana Club. We have the largest cannabis loyalty program in all of cannabis. Our Cabana Club members now exceed 2.58 million members, almost 2.6 million members. Mm-hmm. And our paid membership tier, Elite, is growing even faster. It's growing at 100% year over year. And now we have 162,000 Elite members that pay us $35 to shop in our stores. We offer the lowest price guarantee in the country, and a lot of cannabis customers are price sensitive, and we are reaping the benefits of this move.
And now you mentioned on your earnings call that Canada is slowing down overall, and possibly and for you as well. Do you have concerns about that? Where do you see growth coming from in Canada?
Look, Roger, we've grown a lot. So over the last 4 years, our same-store sales are up 149%, while in the same time period, the average operator in the country has declined or has experienced flat sales. So yes, the sales have slowed down a little bit over the last quarter, and Q2 is generally our slowest quarter. But this can be attributed to less amount of dollars in consumers' wallets. But again, because we are the lowest price guarantee in the country, we are the most appealable concept to cannabis customers. So we feel that even when this impact of the overall industry slowing down, we're going to feel that impact a lot less. As an example, last 12 months, ending December, total industry sales went up just 3%, and Canna Cabana was up 14%.
So do you see opportunities in this? Do you see mergers and acquisitions, or just other competitors not being able to stay in?
Oh, absolutely. Look, as we are the largest cannabis retailer in Canada with 220 current locations, and we've just reiterated our long-term goal to exceed 350 locations across the Canada. And to your point, when industry sales slow down, other operators, like I mentioned, are going to experience more pain. And what this does result is many of them are going to choose to leave the race. And at that point, some of these dollars will come back to us disproportionately.
And are you not worried about having too many stores? I mean, where I live, I think there's 4 different cannabis shops within a half block of each other.
Yeah, you're absolutely right. And this is why our real estate strategy is totally differentiated. We don't typically fight on city blocks in a province like Ontario, which is the largest in the country. You have cannabis stores across from each other, like you mentioned, 4 on major city blocks. We choose to go with the anchored real estate strategy. So we choose power centers, which are anchored by Costco, LCBO, Home Depot, Walmart. And when you go to these plazas, you find a Canna Cabana next to it, offering the lowest price guarantee. So we are not experiencing the same mayhem that others are experiencing, and we remain very bullish on our strategy. We're at a 12% market share in the country, which is up from 11% the year before and 10% 2 years before. Our long-term target is to get to 15% market share, but I think we go past that, Roger.
All right. And looking at Europe, what's the latest on Europe? Remexian in Germany and the UK.
Well, I couldn't be more happy with our advancement in Remexian. So just as a reminder to our listeners, we just purchased Remexian in September of 2025. In Q4, our average monthly revenue was $5 million. In Q1, that average monthly revenue went up to $8 million. In February alone, we've just done $12 million. So you can see how that business is going, and we remain very bullish on the German opportunity. German market is now annualizing over 227 tons in medical cannabis, up from 75 tons the year before. So you can see the massive growth there. And then adjacent markets to Germany, like UK, are very, very interesting, that are growing at 100% year over year. It grew at 100% last year. It's projected to grow between 60 to 100% this year. And we're already in conversations with players to see how we can enter that market.
And do you see legalization coming in those areas?
So in Germany, right now, recreational cannabis it's descheduled, so you can grow 3 plants at home and you can have up to 20, 30 grams of cannabis on you in Germany. But recreational stores are not allowed currently. We see that changing in the next couple of years.
And what kind of an opportunities do you see with that if that does come through?
Oh, exponential opportunity. Look, our ambitions are global. We've said it from day one. We have the best concept in cannabis. Whether you take US, Canada, or globally, there's no such concept as the Cabana Club that exists today. And we want to take our Cabana Club globally. So, Germany will be next, hopefully, and then hopefully UK after that.
And is there local competition there for you?
Not at the moment. Look, there's always competition in every industry, but we're the leaders already in the German market. Our market share went up from 6.3% in the 3 months ended September 2025 to 10.5% in December 2025, 3 months ended December 2025. So we continue to do the best we can in every market, and we continue to remain the leaders in the 2 markets where we operate. We think we can do the same going forward.
All right. And just last thoughts on before we go on the U.S. What do you see unfolding down there?
So U.S. is an interesting opportunity. As you know, President Trump has passed an executive order which could represent a meaningful opportunity for our CBD business divisions, as the proposal is that Medicare patients can be covered up to $500 million in CBD products. We have two of the most leading CBD brands in the country with New Leaf Naturals and Fab CBD, and we are staying in tuned in terms of what the developments look like coming out of the White House and coming out of what the rescheduling actual reform looks like. We'll get more information on that in April, but things are looking really good in the U.S.
All right, we have to wrap it up there, Raj, but thanks very much for joining us.
Thank you for having me.
Raj Grover is CEO of High Tide. Well, Canada's population has been shrinking for the first time since World War II. What could that mean for the already soft housing market and the broader economy? We'll dive into that after this.
Lured by lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them?
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
The Bank of Canada is holding its key interest rate steady at 2.25%, maintaining it the same since October. BOC Governor Tiff Macklem says how long the Middle East conflict lasts and the extent to which it spreads will determine its impact on the Canadian economy. He also says the spike in energy prices will push up inflation in the short term. Macklem adds that it is too early to assess the impact of the war on the growth in Canada. Trans Mountain is planning a series of expansion projects for its main pipeline. The government-owned company says this will allow crude oil to flow faster and tankers to carry more volume by 2027. Trans Mountain says it already exports 60% of its crude by tankers to Asia, adding the war in the Middle East and the U.S. military action in Venezuela are making the pipeline more valuable. U.S. Trade Representative Jamieson Greer says trade talks with Canada have fallen behind while talks with Mexico have advanced. Greer's comments in a U.S. television interview come after the administration prepared for this year's review of the Canada-U.S.-Mexico agreement. The existing CUSMA Pact runs to 2036 and leaves room for a range of negotiating formats. It also includes a clause that allows any of the countries to exit with 6 months' notice. After a mini rally over the last couple of days, it looks like it's ending today. TSX up by 1.3, and the S&P 500 by 0.7, and the NASDAQ by 0.75 of a point. So a rough day all around. And Canada's population shrank again. It's another headwind for an already soft housing market and a broader economy now facing higher uncertainty after the Bank of Canada held rates and warned about fallout from the Iran war. Let's bring in Robert Kavcic, the senior economist at BMO Capital Markets. Robert, thanks very much for joining us.
Of course, thanks for having me.
2 quarters in a row. So I'm reading the number. I want to make sure I'm reading them right. The last 2 quarters of 2025, the number has decreased in Canada, our population.
Yeah, 2 quarter-over-quarter declines to end the year. And then probably most tellingly, this is the first time we've seen a year-over-year decline in population growth ever, going back to World War II, which is the run of data that we have for Canada. So that's a dramatic swing from coming off an environment, obviously, when we were adding, almost 1.5 million people per year, 3.5% population growth almost at one time. That's a major swing for the market and for the economy to absorb.
And what is it like to try and adjust when we go from that surge to all of a sudden we're going to a negative? Can the economy adjust quickly, or does it take a little time to go, whoa?
Well, the adjustment is happening quickly in some segments. I think almost the minute that the federal government put caps in on non-permanent resident inflows, you saw the market respond by loosening up the rental market. That's probably the example that's clear right in front of everybody's eyes. That happened almost to the day, and the market. Remember, before that, the market was kind of really really frustrating policymakers, and policymakers were trying to chase the market with more supply and more supply. And the minute they put those caps in place, the demand curve backed off and the market rolled over and rents started to come down. So the response has been quick. In other areas like consumer spending and the labor market, maybe it's been a little bit slower. What we're actually seeing now on the job market front, though, is as a result of this, you're seeing labor force growth really flatten out. The unemployment rate is actually kind of stabilized off of the high levels we saw last year. So it is flowing through.
And so for the housing market, I mean, for some people, this is good. If you're renting or if you're looking to buy, a lot of this is good. If you own already or you bought recently, you probably are worried.
It's certainly a part of the process to get back towards housing affordability in Canada, for sure. And like we've argued from day one that this was a demand shock that the housing market was facing. It wasn't necessarily a lack of supply because builders were effectively building every last unit that they could. This was a demand shock. And normalizing these demand conditions has kind of pushed us on the road back towards housing affordability. We're not obviously back to where we were, let's say, pre-pandemic or pre-population explosion, depending on the metric of affordability that you use. But this is part of the process to normalize rents and bring house prices back down to levels that make sense relative to incomes and relative to mortgage rates.
And what areas, I don't even know, what areas will be affected? Because, again, you can't say good or bad for this depending on what side of the fence you're on. What areas of the country probably will be affected the most by this?
So within the housing market specifically, we're looking more at the rental market first and foremost, right? Because typically when you see big swings in non-permanent resident flows, those aren't necessarily home buyers per se. They're not out there looking for a 50-foot wide lot with a 4-bedroom house on it. But they are, the minute they step foot in Canada or the minute they leave Canada are adding or removing from rental demand very quickly. And that's where the market swung the most. So from that perspective, I think that's where it hits hardest within the real estate market itself. The spin-off of that is that the investor in the Canadian real estate market has essentially vanished, because if an investor doesn't have price expectations to fall back on, well, they have to fall back on rental and cash flow dynamics. And of course, the problem now is we're in a more normalized interest rate environment. While rents are now falling, cash flow dynamics don't really compel investors into the market. So that's, from a segment perspective, that's where it's hitting hardest. From a geographic perspective, the federal government has a 5% target for non-permanent residents within the Canadian population. Where that number is out of whack is British Columbia and in Ontario, effectively, where those non-permanent resident shares were pushing 7, 8, 9% of the population. So it's no coincidence that if you look at the fourth quarter of 2025, it was British Columbia and Ontario where population was down almost 1% from a year ago, and far and away bigger declines than we saw across the rest of Canada.
All right, and now throw in the Bank of Canada holding rates. No real surprise. What kind of an impact does that have?
Well, it leaves us in an environment where the housing market is just going to continue to struggle through 2026. And look, if you really wanted to wake up the market and you do the arithmetic from an affordability perspective, you can probably argue that if we were to get mortgage rates down to around 3% or slightly below, it would really wake up the demand side of the market. But we're just not going to get there. And similarly, from an investment perspective, the cap rates that are out there in the market relative to, let's say, the cost of borrowing or risk-free government bonds don't make a whole lot of sense. But if we were to see the Bank of Canada to cut rates further and to get that mortgage rate curve down towards 3%, I think the dynamics make sense. But again, that's not our call. And what we heard from the Bank of Canada today is, look, even if there was, kind of a desire to cut rates a little bit, just given what's happening on the growth side with below potential growth or in the job market, any chance of that's been really pushed out now because of what's happening geopolitically with the $100 oil and the risk that filters through into not only inflation, obviously, over the next 2 months, but through core inflation over the rest of 2026. So any hope for interest rates, the short story here is any hope for interest rates to step in and really tighten up the market in the spring are probably not going to go through.
All right. And then just quickly, south of the border, the Fed announcing its decision today as well. You expect it to stand pat?
Yeah, it's definitely our call, and that's pretty clearly what the market is priced in. There's just, similar situation. There's just, if the Federal Reserve was on an easing path, the one thing that the geopolitical developments do is it kind of forces their hand to sit on the sidelines further here. And we suspect that they're going to be on hold right through the summer into the fall. And if there is scope for rate cuts in 2026, it's going to come really late in the year, probably out in September, December.
Okay, we'll have to leave it there. But Robert, thanks very much for joining us.
Great. Thanks for having me.
Robert Kavcich is the senior economist at BMO Capital Markets. Up next, the Federal Reserve, as we were just talking about, will be announcing their rate decision in a short while. We will look at what to expect after the break. We will hear from the Federal Reserve in the U.S. shortly on its rate decision. Let's talk more about what to expect with Blake Gwynn, head of U.S. strategy at RBC Capital Markets. Blake, thanks very much for joining us.
Thanks for having me.
I'm guessing really nothing's going to happen today. What are we going to be looking for? What they say is more important, I imagine.
Yeah, at least in terms of rates, they're not going to make any changes today. But that doesn't mean it's not an interesting meeting. I think this is one of the more unique kind of communication challenges they've really had in a while, because they are almost certainly going to have to increase some of their inflation forecasts. But at the same time, they've got a weak NFP coming into this meeting. I think there's probably some longer run concerns about what sustained higher oil prices could do to demand. Could really drag on consumers that are already a bit stretched, could drag on business activity. So they have to balance those two sides of the Iran conflict. And so they really just have to kind of figure out a way to, talk their way around the fact that their inflation forecasts are going up. And there may even be a chance that the median dot for 2026 takes out that last remaining cut. But I don't think they want to deliver a particularly hawkish message, given all those downside risks I just mentioned.
And there is a lot going on. What will be some key words you might be listening for that will catch your attention?
Well, we kind of have this split between 2 p.m. and then 2:30. So at 2 p.m., we're going to get the statement. We're going to get the dots, which I think are going to be a big focus. There's a chance that the dots lean a bit hawkish, so I wouldn't be surprised to see markets reacting initially a bit hawkish to the statement and the dots. But then when Powell comes out, and this is to your point, what could we hear him say to kind of tone that down or to give a little bit of a dovish tint to the messaging? For one, I think he could focus on labor market concerns. We basically had that February NFP print that netted out, I think, pretty cleanly against the January print, which was very strong. So we had a very strong one, a very weak one. We're basically back to where we were in December, which was a softish labor market that a number on the committee were concerned about. So he could focus on that a lot. He could talk about the two-way risks of what an energy shock could do to the economy. So yes, you have some upside price pressure. He could mention that they do generally tend to look through energy price shocks, particularly those that are essentially supply driven, not really a function of demand. So he could talk about how they're not as focused on the inflation risk, but really more concerned about what higher gas prices could do to consumers, et cetera. So he could certainly, could certainly spend some time talking about that. He could also kind of reiterate, what they said at the January meeting, that the committee is still kind of concerned about labor risks, that they're still looking at potentially cutting by later this year. So definitely some options there and language that he could use to kind of tone back any hawkish messaging that comes out of the dots or the statement.
Do you think we'll hear any mention of stagflation?
I don't know if stagflation. I would, if I had to put money on what's going to be repeated the most, it's wait and see. We think this meeting has a lot in common with last May. Remember that meeting last May, we were coming out of Liberation Day. So very similarly to this oil shock, it was a shock that was going to push prices higher. But something that, really was this exogenous supply kind of shock. It wasn't anything the Fed really had control over. It was due to policy choices. They didn't really know which side of the mandate, labor or inflation, it was going to pull on more. And so you had Powell coming out and repeating over and over through that press conference, wait and see, wait and see, wait and see. He almost gave a version of that answer to every question. You guys saw it a bit in Canada today, where just kind of refusing to really take a strong view on that. So I would expect to see a very non-committal tone, and wait and see might be the key word for today.
And so how long do we wait and see? It really it boils down to what happens in the Gulf, isn't it, in the Strait?
It does, and I do not claim to have any advantage in calling what's going on in Trump's mind. I can forecast some things with a fair amount of competitive advantage. I don't think that's one of them. So I'm kind of waiting along with everyone else on that front. But we do have our first cut coming in 2027. So you kind of strip away, the Iran conflict, and we still see an environment where the Fed would want to hold rates, just given that inflation is still above target. We think they want to continue to be slightly restrictive and don't really have those cuts coming until early 2027.
Now, I mean, Powell is moving out in May. While he's moving out of his position, I think he's staying on, as far as I know, or he was. His replacement is going to be a Trump supporter. What can we expect? Would that put pressure on, though, that we might see a cut?
We're not really ascribing a lot of impact from that handover. And you say he's moving out. We'll see. We have our U.S. Senate kind of locked right now. Tillis on the banking committee has said he will not further the Warsh nomination until this subpoena issue is resolved. We heard recently that the administration is going to appeal the dismissal of those subpoenas. So that could keep dragging out. Theoretically, if everything played out as expected, Powell would be this would be his penultimate meeting. But if this subpoena issue keeps drawing out, and if the administration continues to challenge on these subpoenas, I don't know. Maybe Warsh has got to wait until the August meeting or even September. So we'll see if that happens. But even when it does, he's stepping into a committee of 12 people. He's one person, one voice on a committee of 12. We just don't think he's really going to have the numbers to deliver any kind of uber dovish outcomes or to really change the course of rates. So if they cut, it's going to be based on a turn in the data. It's going to be based on a deterioration of labor. It's not going to be because Warsh is taking Powell's seat, in our view.
And if Powell stayed on, does that have any kind of a real impact or no?
No, again, I mean, I think, this is a committee. And so, yes, you can switch out Powell and Warsh, but I think it's going to be a function of what the 12 want, not one of those 12. And it's going to be a function of the data. So, whether it's Warsh, whether it's Powell, I do think they pretty much stay the course. And again, that doesn't, the leadership change does not cause a big change in my expectations for what we see over the end of 2026 or those first cuts in 2027. That's going to be driven by the data. It's going to be driven by these energy, how this energy shock plays out, et cetera.
Okay, we got to wrap it up there. But Blake, thanks very much for joining us. Blake Gwynn is head of U.S. strategy at RBC Capital Markets. Still ahead, we'll take a look at today's trending trades before we go. Take a look and see what is trending today on what is not a very good day, but there are some people having a decent day, I guess. We'll start with that. We'll take a look at the TSX. Right now, all the indices except for energy are in the red right now, and energy is only up by 0.08%, so it's not like it's that close. Take a look at the TSX for the day, off by 1.25% after that little mini rally over the last couple of days. Now, we have one who's winning right now, the boy, and the ATS. No real reason. It's just doing good, as some people like to say. It's up nearly 5%. No real reason for that. But there's lots going the other way on the TSX. One of them, Boyd Group, missing on its fourth quarter and taking a hit right now. As we take a look at those numbers, sales increase were up, but still overall they saw some same-store sale declines. That was offset. So you can see Boyd Group, they do body shop repairs, things like that. They're off by more than 11%. Another one off today of note, Alimentation Couche-Tard. It's dropping as well. In fact, it's dropping, at one point it was dropped the most by 2 years on a Q3 miss, and it's down 3.82%. Their sales, same-store sales growth, one analyst, Michael Van Elst from TD Cowen, exceeded the consensus and now has increasingly outpaced the industry for 3 straight quarters, and says we would look at it as a buying opportunity if people continue to think that's a loss. South of the border, let's take a look quickly at the markets down there, and a couple of things taking a hit. Williams-Sonoma on their earnings report as well, also seeing a nice little increase, their biggest since August, up by about 4.6%. We're going to leave it right there. That is it for us here. But thanks very much for joining us today. Have yourself a great day.